Did you know that Vanguard has a Roth IRA calculator tool on their website for free? I did not. So I'm going to take a look at it and I'll share my thoughts with you as I work through the tool. How does it work? So BETR. So input your client's data to explore projected asset growth scenarios and calculate break-even tax rates. This will assist you in making well-informed decisions amidst uncertain future tax rates. For a full detailed understanding of how this tool functions, the calculations used to determine your Roth conversion, please download the user guide provided below. Okay. So account type, we have IRA and 401k available. Let's say we have an IRA. Current annual taxable income, 150, that's fine. We are married filing jointly. Current state and local. So here in Nebraska, it's like 4.5%. Oh, round up to 4.6, it's 455. It's your taxable income at distribution. So this is a field used to populate the federal tax rates you may experience in the future, assuming no change in the current tax rates that are in place today. Okay, so 100 grand off my what did I say my portfolio was? Okay, we didn't give the balance yet. So 100,000, I guess. Well, maybe we'll shoot for 10 grand a month, 120,000. Future federal tax rate, and this is where it all hinges. Are we going to be in the 22% bracket? I think that's probably going to be the same. We'll call it 4.6. Okay, conversion strategy. So Roth conversion amount, 50,000. So years until distribution. This is the point at which we will liquidate all the assets to give you the total after-tax balances in the future. Okay, well, if I'm 60, let's say my life expectancy, I'm planning to live to 90, so I suppose 30 years is about the expected end date of that. So how will you pay taxes on the conversion? I would just pay it from my cash in my bank. 0% of my IRA is already taxed. Tax rates assumptions, dividend tax rates 15%, so it's capped gains. Annual return, is that real or nominal? Assumptions you want to use, return. So dividend yield, that's roughly about what the yield on U.S. stocks is right now. Then cash yield is actually a little bit higher than this currently in 2026, but over the long term, that's might go down. I don't know for sure. Okay, so then if we take a look at the chart here, we got this nice little chart. So initially, I'm a little confused because they didn't ask me about how old I was, how old my spouse was, and with the size of our portfolio and how much cash we had. So we have to actually unpack, what is the tool actually trying to do here? Okay, so asset growth. So if you convert to Roth, that'd be my $50,000 conversion, I guess. You pay $13,000, but you'd have $56,000 more in total assets, which would make a Roth conversion desirable today. No, duh. And it's saying I was going to convert $50,000. It didn't ask me how many years I was going to convert for. It assumed 1, I suppose. And 13.3 off of 50 is about 26%. So they just took my federal plus my state and then did a simple calc there. On the break-even analysis side, in 30 years, my client's break-even tax rate, the better, right? That's a nice acronym, marketing department, would be 7% if paying conversions with cash, which would make converting to a Roth desirable today. Okay, so we're saying our tax rate is federal plus state, so it's just shy of 30%. Because, of course, you pay state income taxes on your conversions, and that's the chart. Function of this is the fact that when you make a conversion, you pay with cash, you're basically, in a way, making a pseudo Roth contribution because you get extra money into your Roth account. Because if you took it did the conversion, then you paid the tax out of the conversion, you would lower the amount of money in tax advantage accounts. So it's a good visual way to look at it, I suppose. But what about if I wanted to do multiple years of Roth conversions, like say from when I'm age 60 to 67 when I'm going to take Social Security? I'm not seeing a way to model that. Looks like Vanguard's approach to this is very straightforward, and I think the essential question that you need to answer for yourself is, what's your tax rate that you're going to convert at, and is it higher or lower than what you're going to be eventually taking this money out at in the future? For a lot of the clients I work with, when they do Roth conversions, the amount of money that they're actually converting is such a small percentage of their total wealth that the expectation is that the money that goes into Roth is going to eventually be pulled out by their beneficiaries, usually their kids, long after they're gone. It's like within 10 years, you have to get that money out of there. And it would be based on the kid's tax rate then. But this is saying it's a pretty simplified look. It's a look, if you expect your tax rate to be lower, do conversions. If it's higher, maybe hold off. So while I think this is useful if you don't know anything about Roth conversions, I think if you're trying to get to an answer of well, I've got a 5-year window where I can do a Roth conversion program. How much do I need to do in each year, and how's it going to affect my other finances and my other taxable income? It's probably not as helpful there. And a tool like Holistiplan would be much better, or RightCapital, or any number of tools would be much better at answering. Prelana will be better at trying to get you an answer to a question about like how would I structure a Roth conversion program.